Ask Origin webinar. My name is David Scherer. I'm co-founder and co-CEO of Origin Investments, and I'm super excited to be here again with Michael Episcope, my partner of 15 years. We still like each other. We still work together. It's like an old marriage. It keeps getting better, my friend. So it's great to have you here. Thanks for your time, everyone. We have, I think, about 350 attendees. So obviously there's real interest and demand in what's happening in the multifamily real estate market, the economy in general. Many of you are investment partners, and thank you for that. We greatly value your partnership. Origin has just over 3,000 investment partners at this point. And we take it very, very seriously, obviously, and we invest significantly alongside you, and you know that. So the first thing that we're going to do today, there have been tremendous amount of questions emailed in, and we'll answer as many as we can, as well as the live questions. So please send them in, your live questions. There's obviously a Q&A feature at the bottom. Use it often. Be anonymous, use your name, whatever you prefer. And we're going to start with a survey question, and please answer it because it's going to be very relevant to what we talk about. And we'd like to get your feedback on it. So with that, let's post the survey question, and then we'll jump right into Q&A.
Doesn't allow us to vote, Dave.
I see that. All right, let's get started. So the technology folks, can we move on at Origin? Okay. Michael, let's jump right in. I know you have a question that you want to start us off with. Why don't you go ahead?
Yeah, very high level. So I'll just tell everybody, this is completely unscripted. So the beauty about this is I don't know what Dave's going to say, and he doesn't know what I'm going to say. But I think after 15 years, we can pretty much finish each other's sentences at this time. There was kind of a theme around just the macro economy, and this is something we'll address just up front, interest rates, construction costs, capital markets, et cetera. And there are headwinds and tailwinds in the market. And for anybody who has seen our other videos know that we spend a lot of time talking about capital markets, what's going on. And, you know, the interest rates 10-year today are about 3.25%, significantly higher. And that is taking its toll on the market, especially in financing costs, trying to get new debt. Debt today is about 4.5% on fixed rate debt. A year ago, it was probably 3%, so significant. What you also have to consider there, though, is that debt is a kind of a double-edged sword. Yes, it impacts the financing costs, but what's happening is that our renters, who are essentially millennials, they're peaking at ages 31, 32, 33 years of age, and that's usually a time to buy a house. But the problem is that interest rates are making home ownership unaffordable. So about 20 million people in this country can no longer afford a $400,000 mortgage because of what's happening. And so what's happening from our equation on the math side is that we have all these trapped renters. So our operational performance is actually continuing to set record paces. This year, we're still seeing high single-digit rent increases. We're all seeing this in the paper. But certainly there's an offsetting in some financing costs. So you're sort of running in place right now, and it's not, I think that we have a tendency to look at things in sort of a negative view. And I just wanted to bring that up, that there is a trapped renter issue going on right now that's causing the operational revenue to increase substantially. You've got construction costs. Those seem to be sort of leveling off a little bit, not at the same pace that we saw increases. So inflation, we do see it in our world sort of ebbing. I think we're going to get to more of a 3 to 5% normalized pace. We're not really seeing things come down. And then capital markets. We have seen cap rates go up in tandem with the interest rates, and that's impacting value. And all these things together, are really we're not that far off from pricing where we were 6 months ago, 9 months ago, a year ago. And I would say the market is probably down 10 to 15% when you're looking on a gross basis, right? So if you bought an existing property, certainly we were net sellers in the last year. You're down money in the last 6 months. If you bought it in Q4 of last year, Q1 of this year, you all, I'm sure, understand and know this. We have embarked on a barbell approach, and we did this a long time ago, right? More than 2 years ago, we stopped buying existing properties because they were trading so far above replacement cost. And we are in debt and we are in ground up development, because the only way to buy right in this world today is by adding value and getting into the land and building. Because if we can build for 300 in a world where properties are trading at $400,000, we like that equation all day long. So we are, as a company, we're defensively positioned. I think one thing we're really good at is risk management. And the macro environment is always something we're monitoring, we're looking at. We have hedged interest rates to a degree in every single one of our ground up development funds. And the last thing is, from kind of a fundamental standpoint, there's still a housing shortage in this country. So this isn't 2007, 8, 9 all over again. We're optimistic about the future, but like any asset class, nothing grows to the sky, right? We're going to go through these. The long-term trend is up, but we could see blips along the way and some, some downturns like we're in right now. So that wanted to sort of frame the conversation around the macro, because so many questions were about interest rates and construction costs. So we're just going to knock those out. Dave, that's all I got.
Going on, my friend. I'm going to jump right into. I'm not going to add to that. I thought that was amazing. Good answer. The bottom line is rents are going up, and it's mitigating everything Michael's talking about. So when you look at CPI, 25% of CPI index, that monthly number that you're looking at is the cost of rent. That's how the cost of housing is measured in CPI. So when CPI is going up, it's actually meaning that our rents are going up, and they are. They've gone up significantly in 21 and the first 6 months of this year. That's the ultimate mitigant of construction costs going up, of interest rates going up, some of these other variables. Our net operating income, or our EBITDA, is going up significantly. I want to answer a different question, which is more specific to our Income Plus Fund. So the Income Plus Fund is our open-ended fund that invests both in preferred equity and common equity. It's structured to be very tax efficient, meaning it provides a dividend, but you generally aren't paying any taxes on that dividend. So the Income Plus Fund, as Michael mentioned, has been very defensively positioned, meaning we have a lot of preferred equity investments. We have a lot of build to core with very, very high margin. And so if you think about a high margin investment, if you're building to a 40% margin and now the margin is squeezed, you're squeezed to 30, but you're still making 30%. You're not losing money, you're losing 10% of your margin. So we're very proud of the returns, first of all, of that fund. If you're a partner in that fund this year, it's tracking 12 to 13% in a year where nothing else is going up. And so, we're very proud of that. Preserve and grow. And we say it all the time, preserve and grow. So the question I had that I want to answer is, within Income Plus, when will we start looking at acquiring direct assets again? And it's a great question. And in this case, it's a very easy answer. There's very, very many ways that we look at real estate. There's, discounted cash flow analysis. But in this case, what we're really focusing the most on is replacement cost analysis. And the reason for that is Origin develops, operates, and lends to real estate. It's always multifamily, and it's always within our target markets, right? The Southeast, Texas, and the Southwest. But we have a lot of latitude and a lot of flexibility to find the best risk-adjusted returns within those various asset class investment decisions. And we made a choice 3 or 4 years ago that we wanted to be defensively positioned. We wanted to be in prep. replacement cost analysis, and by the way, in development, why do you think that we're so heavily in development right now? It's because there was a huge risk return transfer in the last 3 or 4 years from core buyers to developers. And the developers were on the winning end of that. And the core buyers were on the losing end of that. That's why we moved to the development side. All you need to look at is replacement cost analysis. It used to be that, like, for example, in Texas, we've been there for 10 years. We used to buy new product at or below replacement cost. And in 2020 and 2021, you had to buy it 20 to 30% above replacement cost. Well, that's an enormous wealth transfer from core buyers to developers, largely fueled by the way, unbelievably low interest rates. Because buyers are, core buyers are looking at their levered return. And when you can borrow at 2.5%, everything makes sense. But we didn't believe that that would continue, that was a distortion. And so when would we go back into buying core? When we can buy at or below replacement cost. And by the way, it's trending that way. It's not there yet, but it's 50% closer than it was 8 months ago. And so if it continues to move that way, we'll start to move towards buying direct assets again.
Great. Which open fund should give the biggest after-tax return over 15 to 20 years, not looking for income until then? So you have some really good choices, actually. If you have capital gains, there's no doubt it's going to be your QOZ investment. QOZ is just real estate supercharged, and real estate is already a tax efficient asset, and QOZ just makes it that much better. So if you're looking at the after tax, that's for sure QOZ. If you don't have capital gains to invest, then it's probably somewhere close between the Growth Fund IV and the Income Plus Fund. And the Income Plus Fund, the target there is 9 to 11% per year. So that is sort of steady as she goes. And we try to create that in a very tax efficient manner and also with minimal volatility. The Growth Fund IV is 100% ground up development. In the first kind of 3 to 4 years in Growth Fund IV, the target return is twice that of what you will achieve in the Income Plus Fund. Now, after that, if you elect to stay into Growth Fund IV, the tagline there is invest for growth, stay for income. And you can, and that is going to be extremely tax efficient, but you will be 100% exposed to equity. So equity, as you know, it's 100 unlimited upside and limited downside. And there will likely be more volatility in that fund afterwards. But the nice thing is that investing in that fund, you've protected the downside by building a big cushion against loss. So the idea is that we're delivering about a 1.7 to 1.8 net multiple at the end of 4 years to invested capital at that point. And if you want to stay in, then you're cash flowing from there on out. And with the Income Plus Fund, if you don't need income, then you just opt into the dividend reinvestment plan, and it becomes more of a growth curve than for the individuals who are actually taking the income. And then you can turn the drip off and you can elect to take that income.
Okay, we have a question about alignment. So essentially our co-investment in funds, and I want to address it. We're going to try to address all the questions, but we talk about this all the time. I don't know if we're the most aligned firm. That would be hard to know, but at our size, it would be difficult to find a firm where the principals and senior management team invest, 7 to 8%. We're at $1 billion in equity under management, and 75 to 80 million of it is us. So we obviously really believe in our products and our funds. And increasingly, it's our team, not just me and Michael. But the question was, like, how do you break that down fund by fund? We have 8 funds. Some of them are realized and some of them are open-ended, and but it's pretty straight lined. I mean, we started, with significant investment in Fund I. I think we were 30% of the equity in Fund I, Michael and I. In Fund II, maybe we were 15% of that equity. Obviously, as the funds get bigger and bigger, you're going to be a less percentage, but it's still significant. We invested 10 million of our capital in Fund III. I could go on and on, but like when you start to think about QOZ, Qualified Opportunity Zone funds, Michael and I both have invested significantly in those funds. You're limited there by capital gains. Like you have to have capital gains in order to qualify for the tax advantages. And so, I can only speak for myself. I've invested significantly in Fund I, Fund II. I'm invested, but I'm going to invest more as we realize capital gains from Fund III, which hopefully will happen this year. As we sell the remaining assets in Fund III, there will be significant gains that are realized, and then you can reinvest that capital. So I don't want to go fund by fund. I think that's a little too much information. But think about Michael and I as we've invested 75 million between us into our funds, and I gave you a little flavor of the first three, and you can move through time. It's a real commitment. But moreover, I'll just speak for me, but I know Michael agrees. I do it because I can't find better investments, and they've proven to be very, very effective and also very safe. And that's why I do it.
Yeah, Dave, if I can add to, I think just kind of pulling the cover off and looking under the hood, there's a lot of, in the world of GP co-investments, there's some people who are out there where the manager actually doesn't have a lot of money in, but the GP co-investment looks good because they pass the hat to friends and family, and that matters. And I think what's embedded in this question about alignment is, do we have your interests at heart? Are we doing the right things? Are we acting in a fiduciary capacity, right? And that metric of alignment, how much are we investing? I ask the same question to managers because that's the best thing. David and I started this firm to protect and grow our own wealth. We came out of different industries. We still use this as a way to protect our wealth, to grow our wealth, to produce passive income. And I think the best story I can share is this is about 5 years ago when we really started going out to individual investors via digital marketing, meeting new people. And one of the individuals in our investor relations department, as people were doing their due diligence and digging in, and everybody's skeptical online, and you should be, but he said, you know what I love about my job? There's no gotcha moments. There's nothing in the PPM that's on page 10, page 20, page 30, page 50 that we're hiding, because our litmus and the way we look at the world is, if we didn't work here, would we want to invest here? And so we're building something for the long term, and something that we don't, like when we started in 07, 08, there was a huge void of an institutional quality platform geared towards individual investors. And we take that very seriously. And, our values, it's about doing the right thing always, and making those decisions and thinking about in both seats, as the investment manager, as somebody who is leading the team and making sure they have opportunity, and also as the investor, and making sure that we're doing the right things for our investment partners out there. And it's that balance that I think David and I have done very well over the last 15 years. Dave, there's a quick question I'll answer. What's the status in DC of extending the OZ program and bringing the 15 to 10% cap gain step up back? That is pending legislation. The best of my knowledge is that it's going to be voted on in Q4 of this year. It looks very likely. Again, there's bipartisan support. Some of the support on the edges has sort of dropped out, but putting a number on it, 70 to 80% of Congress still supports the QOZ program. They're probably going to make little tweaks and reporting changes, but nothing significant, because the program, it was created out of the 2017 Jobs Act, and it's working. It's creating a lot of jobs. So it's very, very likely that will come back. We just published an article about it, and we'll keep you posted. We're keeping a tab on that ourselves.
I'll answer two related questions as well. The first question, they're both anonymous. Thanks for your question. Who do we consider our competitors? I believe you mentioned Blackstone before, but I'm thinking about the crowdfunding space, firms like CrowdStreet, Cadre, et cetera. It's so funny. We had this literally discussion yesterday at strategic planning meeting. I would have to break it down by fund, because we have different competitors for each fund. We have 4 active funds, all in multifamily, in different risk return profiles within multifamily. But Yes, Blackstone is a competitor. A few others I'll mention, and I want to mention the ones that I think are very good firms and good options. I think Origin is, we're a top SL manager, so I want to mention other firms that are in the top quartile, if you will. I believe anyone I'm mentioning is not. We're top 3%. But these are fine firms. Blackstone's a good firm. I would say in the development space, we compete with certainly Carlisle, to some extent, Grubb, and regionals. But then when you move to the credit space, you have all kinds of credit funds and yield funds. But certainly in the credit space, on the deal sourcing side, we compete with firms like certainly Heitman, Blackstone, Kane Anderson, Bridge. So these are the types of firms that I believe we compete with. Now, there is a subset of investors that want to invest deal by deal. And this is kind of transitioning into the next question, which is there are so many crowdfunding real estate investment opportunities out there. This question says how much fraud goes into those investments. I don't know how to answer that, but I'm going to answer it a different way. I believe that these two-sided marketplaces where you can go and invest in a deal generally don't serve investors well. And it's not necessarily that the deals are good or bad. It's that I don't think that investors have the knowledge necessary to make the decision that is the most accurate. And it's not because they're not smart, it's because they're not trained. I don't know how to fix my car. I actually hire someone to do that. But Origin and our team, we actually really do know how to find good deals, develop good business plans within real estate, manage the risk, et cetera. I'll just give you an example. If you were going to a site, I don't want to name the site, but fill in the blank, and there's a deal, do you have the financial training to pull up the model and understand what's in the model? Not in the deal write-up, in the model. And if you do, so you have that skill, do you have the domain knowledge to question the inputs of the model? I mean, do you know that the cap rate is correct, or that they're drifting the cap rate, or that they're not trending rents, or that the expense ratio should be 35% in that Texas market, not 31? You just keep going down a wormhole. Do you know this stuff? Because unless you do, I would recommend you hire a consultant, literally. If you don't know it and you're going on these sites and you're going to invest 100 grand, you should probably pay 5 grand to somebody who does know it. We don't do that at Origin, but what I'm trying to drive at is our mission is to help individual investors make better decisions, whether you invest with Origin or not. We're a large company. We're a profitable company. We don't necessarily need more investors, but we do want to help. You might find that help here as a partner. But if you don't want to partner with us, go to our education site. We have 250 articles and videos about, you could get an MBA in real estate on our education site. It matters to Michael and I.
Next question, explain the advantage, disadvantage to waiting in a closed-ended fund. This one's specifically about multifamily credit fund. This is actually very timely. Jonathan Spitz, our AVP and investor relations, just wrote an article that went out on Origin Insights. So you can read this article if you go to the website, the education system. The simple explanation is this: if you're getting in later, you are going to pay the earlier investors. You're basically paying them an interest rate. You're paying them the preferred return on their money by getting in later, because you're getting a free look. And everybody in a closed-ended fund is equalized as if they came in on day one. The advantage of getting in later, and this is a quote from an investor, he said, it's like betting on halftime. You actually get to see the investments in the fund. So in the end, you're betting on our ability to put out deals. To Dave's point, you can see the investments in the fund, you can touch them, you can see all that. But when you're investing, you're betting on a manager. more than anything, and certainly in a particular sector. So there are advantages and disadvantages to getting in later. And I encourage anybody who's not familiar with those to read that article, go to our website.
So a related question was specific to multifamily credit fund. That's our least risky fund. It's returning anywhere from 8 to 10% net. And so the question was, what is it better to invest now in the existing fund? Is it better to wait? I'm assuming they mean for the next multifamily credit fund too. I would say probably it's better to invest now. And the reason for that is we've been working on that fund for 2 years. It provides current yield today because it has 17 investments, all producing yield. Net yield is, anywhere from 8 to 9.5% on a net basis. So you're buying into that income stream. We don't mark up the assets, even though, we believe the portfolio has gained value from where we purchased it. So I would say, a lot of the times I will tell you that it's about trade-offs. Like, for example, when Michael was saying, the trade-off in investing in a lot of closed-ended funds is you get more information if you wait, but you don't get the preferred return unless you invest. So there's a trade-off. Here, I don't really see a trade-off. I actually believe it's probably better to invest now than to wait.
Next question, what combination of circumstances would make ground up development infeasible? Dave touched on this already. Basically, it's math, so I'll just take you through. We look at a metric called return on cost, which is a future cap rate. And so if a project costs us $60 million, and I'll use round numbers here, a 6% return on cost means that project will produce $3.6 million in net operating income. And that's the cap rate in the future. And if you look at current cap rates, if they're 4, then what you're doing is really capturing that spread. And what we look for is typically a 30% margin or greater on our development projects. So if the cap rates today are 4%, then we're looking at a 5.2, 5.3, something like that, and making sure that the math works out. Certainly, the higher interest rate goes, the more return on cost that we need. So as that starts to come down and you see prices coming down and that deteriorates, we will stop doing ground up construction. And the way we evaluate the market is it's very simple. We're looking at the cost to construct new, and then we're looking at where existing properties are trading. So if we're building a 200 unit property and every unit is 1,000 square feet, and we can look at another brand new property in the same geographic region, and that's at 200 units and 1,000 square feet, and that sells for $80 million, that math works all day. If suddenly the market deteriorates and that $80 million property becomes worth $65 million, comes down by 20%, the math no longer works on ground up construction. It's also the 2 examples I gave you there. If we're wrong in ground up construction and we're in this period where prices are coming down, it's not that we're losing money, we're just making less money. But if you bought that property at $80 million and it goes down to 65 and you're levered up, you've lost a significant amount of capital. So there will be a time, most likely, there are ebbs and flows of these markets and cycles, that ground up construction no longer pencils out. Today, it's penciling out. Not as much as it was, I would say, a year ago. Deals are much harder to find than they were 6 months ago, but the deal team is doing a great job of finding opportunities out there that still work for our QOZ Fund and Growth Fund 4.
Simon, thank you for your question about multifamily credit fund. And interesting enough, there was an anonymous question that was identical. So they're asking about the availability of investment from accredited investors into the fund. Right now, it's limited to qualified investors. The difference being an accredited investor has $1 million in net worth or $200,000 of annual income. $300,000 is a married couple. A qualified investor has $5 million of investable net worth. So it's just a higher standard. And by the way, the reason we did that is it's a regulatory reason that the way the fund was structured, we were limited to 99 investors unless they were qualified. And we have more than 99 investors. So The short answer is we can't do it in the existing fund. That fund will invest through January of next year, raise money and invest, and possibly invest after that for another 12 to 18 months, but certainly only raise money until January of next year. And then we're going to set up multifamily credit fund II. We're already talking about how to structure that fund and potentially add accredited investors to that fund. But there are legal reasons behind that. And not to get in the weeds, but the big difference is this is buying bonds that are, collateralized by multifamily. That has a different regulatory structure, if you will, than our other funds where we're, controlling interest in real estate on the equity side. So it's a little bit different. But thanks for your question, and we'll follow up as soon as we know for sure. But I believe, and Michael, I think you would agree, we're trying to make multifamily credit fund II available to accredited as well as qualified. I mean, that's one of the things that's important to us.
Here's a tactical question, but probably one that's really important here. How do I actually invest? So a couple ways. You can email me always, michael@origininvestments.com. I'll send you to the right department, or you can email investorrelations@origininvestments.com. You can also go to the website. We have a chat box there. You can just put your name in and say, I'm interested in investing. And somebody from our investor relations team will get back to you within 24 hours.
Here's a really, really good question. Thank you for your question regarding portfolio allocation. And it's really interesting. I gave a presentation yesterday to a lot of registered investment advisors. We have, I believe, 62 partner firms that are essentially investment advisory firms, and they invest client portfolios into Origin funds. And so I was presenting to these investment advisors about, not necessarily about how much of your portfolio should be in real estate, but this notion of non-correlating assets in a portfolio. That's really what it was about. And if you think about the last 40 years, we've been in this secular declining interest rate environment. And so, bonds, the yields on bonds were at 6, and then they were at 5, and then they were at 4. And, there's a business cycle element where the Fed raises rates or lowers rates based on the economic cycle. But the secular long-term trend has been lower, lower, lower. And now we're at the first point where inflation seems to be real. We don't know how long it's going to last, but, is the paradigm changing? And what's happened at the portfolio level is the traditional stock and bond portfolio, it's a 60-40 portfolio, 60 stock, 40 bonds, and it tends to get weighted a little bit more towards bonds as people age, because they want less volatility, more certainty. But it's under question, because if inflation is causing a correction in the stock market, you have a correlating portfolio the wrong way. Your bonds are going down in value because inflation is high, and yields on bonds need to go up, and the bonds move inversely with the yield. So you're losing money there, and then you lose money on stocks. And that's what's happened this year. I mean, you've had 10%, 20% losses in both. And so what's interesting is when you sub out multifamily real estate, if you just, this was my presentation yesterday, if you take a 60-40 portfolio and you shrink it down to 50% stock, 30% bonds, and 20% multifamily real estate over any horizon. I looked at it over 22 years, and I looked at it over 1 year, and then I looked at it over 6 months. And by the way, if you're interested in this analysis, we can share it with you. It's quite detailed and in depth, and it's massive data sets. Not only did your return go up over 20 years, 1 year, 6 months, significantly, but your standard deviation went down, which means the risk of your portfolio went down. And that's very rare in investment. It's very rare that you add to a portfolio by increasing your returns and decreasing your risk. That's kind of like that's what everyone is looking for. And then the last thing I would say is the pioneer in portfolio construction is a guy named David Svensson. He managed the Yale Endowment for 25 years, starting in the mid 80s. And he redefined what that meant. And he's written lots of books. It's Sven, Svensson. And he became the leader in the space. But basically, he did this. He lowered stock and bond allocations, and he subbed in real estate and private equity. And he greatly outperformed over the last 25 years, really anybody in the space. And it adds up. Like if you're getting 200 or 300 basis points more a year, it doesn't sound like a lot, but over 20 years, it's massive. Like what happens, the amount of wealth he created versus other endowments. And so that's been broadly adopted in that space. But Michael, I'll ask you a question. So once you believe, and this actually relates back to our poll question. Remember, the poll question was, what's the most important variable to you selecting manager, right? And what Svensson would say is, in these alternative investments, it's the value and the experience and the track record. It's the selection of the manager, like nothing else compares to. So my question to you is, if you look at real estate managers sorted by quartile, how big is the dispersion? Like if you wind up selecting a top quartile manager versus a bottom quartile manager, what's the return dispersion to an investor over a 5-8 year period?
Yeah, it can be massive. I mean, this is why in the private markets, it makes so much sense. We've talked about this in the public markets. If you're wrong between an ETF and a mutual fund, you're going to be off by 20, I don't even know, 2% maybe a year. In the private markets, the difference between a top manager and one in the bottom quartile can be one doubles your money and the other one loses all your money over the same period. So you got to get this part right. And I think you and I are both fans of David Swenson and doing your homework and betting on the jockey, not the horse itself. So that's where you need to spend your time.
Great question just came in. It's kind of relevant to this conversation. Anonymous, thanks for your question. Can you please speak to your senior management team? Aside from Michael and David, do you have a transition plan in place since QOZs are such a long-term investment, 10 plus years? Yes, and by the way, with QOZ, it's a 10-year investment, but you have the option as a QOZ investor to stay in for an additional 15 years. If you want, I will, I know Michael will, because you continue to accumulate all of those gains tax-free. You essentially constructed an IRA out of thin air. It's amazing. It's an amazing long-term investment, but you're 100% right to ask this question, because if you're looking at a 10-year commitment, what's the business viability? What's the team? Can they develop? Can they operate? Can they manage risk? I mean, all these things will come into play. So to answer your question, that's the thing that you should ask first. First is, what are the returns? What have you done, right? The second is, do your new funds and strategies look like your old ones? Because if you have a really successful manager that's doing something completely different, they actually don't have a track record, right? And so that would be relevant. And then a subset of that is, if you've had a lot of success and you have this data, is the management team the same, executing a similar or the same strategy? And is it the same? Is it the same people? And at Origin, the answer is unequivocally yes. Our top management team have been here from 7 to 11 years. And so the same people that sourced and created business plans and executed business plans and managed risk in Fund 1, Fund 2, Fund 3, QOZ 1, Income Plus, they're all here. We've lost no one. So we've added, and we have 45 people now at Origin, but the core people that helped build and form and create our track record, they're all still here. But that's a really relevant question to ask anybody, and it should be the top of your list. And so then that answers sort of the question about transition plan. It's not the David and Michael show. It hasn't been for many, many years. Certainly we are in the game, we work very hard every day, but there's so many talented people here that there's lots of inputs into the product. It's not me and Michael. We're one, like, for example, my team's 20 people. That's the analysis, acquisition, and investment management team, and they're dispersed all over the country. I couldn't do that job without them. There's no way. And Michael, I'm sure you feel the same about your team.
100%. Yeah, it's definitely I mean, even from when David and I formed this company, we didn't call it the, Episcope Scherer company on purpose. We always had a bigger vision to build something that was sustainable and long-term and growing. So it is a great question about tenure of the management team and who's here to take over if you and I get hit by a bus. So, it's interesting. I'm reading like 5 or 6 questions together, and I keep seeing like interest rates pop up in every question. And there's one year, at what interest rate do you simply break even in the QOZ fund? And it's a good question. And when we stress test, interest rates could go to, like, there's a lot of variables, right? So if you're just holding everything constant and looking at interest rates, you're probably talking about 7% interest rates, right? That we would have to finance at, because keep in mind that if you're looking at a project that we are using 65% leverage on cost, and then we're building to a 30% margin on top of that, when we're done, we're going to be at about a 55% loan to value. So if all we're doing, if the capital markets fall apart and we're putting on interest at 55% of the property, and those interest rates are at 7%, but the cap rate on that property is at 5.5%, you can do the math, and it's still actually positive cash flow from there. The real risk, and this is another question, is just where are the capital markets in 3 years, 4 years, 5 years? Where are cap rates? Where are rental rates? Where is inventory? There's only so far that we can look out into the future. Demographics are easier to sort of forecast because you can see these sort of bubbles of people moving through. We know where the millennials are going. We know where the baby boomers are going. We know where the group behind them are going. But the other things are a little more challenging. And so the further out you go, the more dispersion you have on the outcome. And there was a question in here about Growth Fund IV. What are the big risks there, to the outcome? And it's capital markets. It's interest rates, it's cap rates, and really it all comes down to exit price and the variables that go into creating the exit price, because we will buy the right projects. We will build them on time and on budget. We will lease them up. And then the question is, what are they worth in 4 years? And we spend a lot of time in analysis making sure that we're getting our growth rates right and our rental rates, and that we have a cushion against loss. So, if we believe that the market is $1,800 per unit in rent, and we can rent for $1,650 a unit, that feels really good. We will try to capture the 1,800, but we always are looking for meat on the bone and multiple ways to win. And that's, I would say to anybody, that's one thing you have to be careful of in all of these business models, is looking for things that are priced to perfection, because priced to perfection, if you go back to 06, 07, 08, that was the word that everybody used. There was only one way to make money, and there were several ways to lose money, and there was an asymmetric outcome that was setting up. We look for the opposite. We want the asymmetric outcome to be to the upside. And I always tell people, if you're in one of our credit committees and you're listening, it's you understand when we're underwriting to a 4% or a 4.5% exit cap, and cap rates today are 3.75%. That feels really good. When we can make a project work at $1,700 rents, and equivalent properties today are trading $1,800 or leasing for $1,800, that feels really good. So it's those calculated bets that we're constantly taking, and anything that is pioneering or is priced to perfection, we just pass on. There's always another bus that comes by.
So I have a question here. Anonymous, thanks for your question. It's great to see you're so aligned. I'm curious to know how much of your investable assets are in real estate versus stocks and bonds. I'll just cover that broadly. And I think, Michael, we're on the same page here, but we're skewed towards real estate. And that shouldn't surprise you, because Michael spoke to this today. We set up Origin because we wanted to create a better firm, but also a place that we had full transparency into not just the investments, but the tax structures. We're tax investors just like you are. All of our funds are very tax efficient. Just the transparency, the alignment, the competitive advantages that are so apparent. So it would be impossible for me to invest in other things and get that same comfort. So for Michael and I, we're very much skewed here. I will say since '08, we formed in '07, but significantly started investing in '08. This has greatly outperformed stocks and bonds, what we've done here. I do have other investments, both public and private, but the majority of my wealth is actually here. I'm not recommending you do that. I'm not an investment advisor. That's not what I'm saying. I'm simply answering the question honestly, which is, I'm greatly weighted towards Origin, and that's been a very good choice.
David and I actually went out and commissioned a study by two PhDs about 5 years ago now, maybe 4 years ago. And we asked them to look at what is the optimal amount of real estate in a portfolio. And what came back is that the more real estate, public and private, that they added to a portfolio, the better it did on an absolute and a risk-adjusted basis. And it was interesting because they said, look, we can't, like, it's irresponsible for us to say that somebody's portfolio should be 90% real estate and 10% S&P. We agree with that. But that's the reality, is you have this asset class that over the last 10, 20, 30, 40 years has outperformed the S&P 500. And a lot of people, they don't even realize that. And there's reasons. Real estate it's tax efficient, it's stable, it produces cash flow. Even when you look at the public REIT market as well, and you can't say that about a lot of the companies in the S&P 500. So what's the right ratio? I think it depends on you as an individual, how much net worth you have, how much you're willing to, how much illiquidity you can handle as well. But I'm with David. Like, it's been the best investment that I've made over the last 15 years, and I'll continue to have a significant amount of my wealth in this portfolio. This is another question that I want to answer because it talks about this. But for passive investors, what's the long-term advantage of private real estate funds over public REITs, if any? I will say we're advocates of public REITs. We think they're great. You can get exposure to a lot of different assets very quickly. The difference is that you're buying beta. That you're buying into a portfolio of assets, and there's oftentimes that the stock of the public REIT is completely disconnected to the underlying value of the assets. And we see this in the public markets. We follow the public REITs as sort of a proxy for what's going on. There are REITs within the apartment sector that follow the same markets that are down 40% because of what's going on in the market with multiples right now. I can tell you that the general market is not down 40% in the multifamily sector. So might be a great time to buy those REITs today, but we sort of look at those. The advantage of getting into a private real estate is alpha, that we are creating value for you through ground up construction. There's a defined strategy. You're getting into deals that you otherwise can't get into through a public REIT, and also less volatility. So even when you're looking at something like the Income Plus Fund, multi-strategy fund, you're getting into core plus real estate, which is sort of beta. It's more like what you would buy in a public REIT. And then we also have debt in that fund, preferred equity, and we have ground up development. And the idea there is that we're generating 9 to 11% on an annual basis, but with minimal volatility and also minimal tax consequences. So I would say that it's an and, not an or, because a company like ours, we can only get you exposure to multifamily. But if you want to be in telecom, and you want to be in timber, and you want to be in data centers and all of these other sectors that fall underneath real estate, then you really need kind of both, so you have a diversified portfolio.
I completely agree. It's an and. I would just add, I don't think it's an and go into individual deals. And I talked about it before. Public REITs, yes. High quality private real estate, private equity managers like us, yes. Individual deals, no. That is not for the individual investor, in my opinion. You're set up to lose there for a lot of reasons. We could do a whole webinar on it, but some of them are structural. Okay, so I'm going to answer a couple questions, Michael. One, David, thanks for your question on single family homes versus multifamily. I'm going to just define, because you started talking about single family home portfolios. We talk about build for rent. I just want to be specific. Build for rent means instead of building a 5-story stick or an 8-story podium or a 7-story wrap product or whatever, you're building horizontal multifamily with a shared clubhouse. And so think about 200 units, one go up and they're more dense urban, and the other go out. Those are your horizontal build for rent strategies, which we're doing a lot of. The trade-off in build for rent, there's enormous demand for it. Michael spoke to this. There's so many trapped renters, they want to own homes, but they can't because the mortgage rate is 5, 5.5. It used to be 3, 3.5. And the price of housing's gone up so much. So now they're renters. But a build for rent is a home. Oftentimes it has a yard, a small yard, a garage, sometimes attached, sometimes not. So it gives you the feel of a home ownership, even though you're still a renter. And there's a lot of demand for that. One of the challenges in build for rent is you need large land sites because you can't build up. You have to build out. And so you want to find large land sites that are also near demand drivers. And those demand drivers are normally walkability, access to retail, some of the things that as a consumer you're going to want. And so the site selection is very important. And then of course, you also have to buy the land at a viable price. And so the ultimate way Michael and I and our teams mitigate risk is you buy land or you buy buildings at the right price. Right. So like right now, here's another question we had, and I'll relate it to this one. The question was, will oversupply hurt multifamily real estate? And the answer to that, I mean, obviously it's market by market and submarket by submarket, but in general, the answer is no. And the reason is we're undersupplied in multifamily. We don't have enough units. We're massively undersupplied all the way back to the Great Recession. And so broadly, we don't have a supply demand issue. Right now, what we have is an overvaluation issue. Like multifamily real estate was valued too high in 2021 because the Federal Reserve took interest rates to zero for too long. And so now that's correcting and it's actually de-risked massively. So it used to be the multiple on earnings was around 28, 30. Now it's 23 to 25. It's de-risked, right? It's moving back to a sustainable valuation level. Interesting enough, it hasn't really caused that much asset erosion because NOIs have gone up so much. So I like the supply-demand dynamic. Of course, it can be oversupplied in a submarket in a particular city. That's why we're so heavily invested in the Southeast Texas and the Southwest. That's where all of our offices are, our people, our operations. Because at the end of the day, demand is created by people. Right? People consume real estate. People rent apartments. And so you want to be on the right side of demographic trends. And that was a decision we made 10 years ago. Now it's supported by our data scientists, our machine learning. It helps us make decisions. But even before the machine learning showed up, I believe we made the right decisions in 2012, 2013, 2014. We understood that that's where people were going to move. And that's your demand for apartments is people create that.
So here's a question. Are you as optimistic today as you were 6 months ago, a year ago? And I'm going to kind of answer that in two ways. Certainly, we would love to be in an environment where we were a year ago, where interest rates were 2% and not looking at 3.5% in the 10-year. There's a lot of volatility. The stock market has come off. A lot of things have changed, and David and I are, as susceptible as anybody to investor sentiment and looking at that. In a normal world, we'd love it if things just went slow and steady, 3% every year, and that's kind of what real estate, especially in the multifamily side, has done. And we have to deal with this volatility and this growth brought forward and the uncertainty and the geopolitical everything and just headwinds forward. What I'm optimistic about, though, is how we're positioned. And we've been talking about this for years. And I feel like we've finally been vindicated because our shift to a defensive strategy started in about 2019, pre-pandemic. And it was in a world where we saw this relationship between replacement cost and building starting to change. And our team was coming to us. We were doing a lot of value add at that time. we just kept looking at it and going, I don't understand. Like, okay, we're buying this for 270,000 a unit. We're putting 25,000 into it per unit, and then we have to sell it for 350,000 to make a profit. And at that time, you could build for 300,000 a unit or 320 or something like that. And you know, some properties were trading more. And we saw that equation start to shift. And certainly COVID, for anybody who was doing value add and buying existing properties in 2019, 2020, they were vindicated, right? They were let out, and COVID has really inflated the asset prices considerably. For us, though, that equation has gotten so far out of whack, and we've been spending the last 2 years rearranging our income plus fund, focusing on our ground up development strategy, building the multifamily credit fund so that we are defensively positioned. Because our first thing that we always talk about is protecting capital, and you protect capital by choosing the right strategies at the right moment in time. So, you know, the economy is something we would love to go back and have the information we have today. And there's never going to be a time that we wouldn't like to have last year's prices today. And I think we'll be saying in 5 years, boy, I wish we could build at today's prices tomorrow. And that's one thing that you can be sure of, is that over the long-term trend, replacement costs and prices will continue to go up over time. And that's really what we're optimistic about, is over the next 3, 5, 10 years, and then how our portfolios are positioned to take advantage of any dislocations that do happen in the market.
Yeah, Michael's absolutely right. Even in the Great Recession, where you had an unbelievable recession and massive unemployment, and it really hit construction and real estate the hardest because there was no lending available. Construction prices barely went down. I mean, initially they didn't go down at all, and then they went down, 3 to 5%, and then they immediately started going up again. It just doesn't happen. They go up and then they tend to plateau and then they go up again. And that's what we typically see in real estate, which is the underpinning of long-term growth, replacement costs I talked about before. Adding on to the discussion about public REITs, Anonymous asked which REITs are most similar to Origin. Geographically, we follow all of them. There's about 6 to 8, but the two that are most similar to us are Camden, CPT is their ticker, and MAA. And they both cover, the Southeast, Texas, and the Southwest. So geographically, they're similar. They're very different than us in terms of development and preferred equity. Most of what we do at Origin is either development or preferred equity. And so they're all owners of assets that they buy at the core level. They don't build them. I mean, they do a little bit of development, but it's just a fraction of what they do. And like in our case, it's the bulk of what we do. And so I would pose that Origin is much more idiosyncratic, and you have to believe in our competitive advantages and that we're building to a high margin. And they're much more market driven. They're going to get the market rate return that is available, which, by the way, real estate gives you a nice return at the market rate over time, and they're good at that. I think Origin has and will continue to outperform the market rate return. I'm going to answer one more. Can you speak of the lessons learned from QOZ 1? What did we learn in QOZ 1 that we applied to QOZ 2? Very simple. In any business, you have to look for the scarce resource. What is it? And in QOZ, the scarce resource are quality development sites. Because if you think about what we do at Origin, we're only in these markets. And then we use AI in our own field to further shrink the markets to the submarkets that we think will outperform in the city. So now the subset's even smaller. And then you have to overlay the QOZ map, which makes it even smaller. And so there's a very small opportunity set in QOZ. We intuitively knew that in QOZ 1, and we started tying up sites way before we raised capital. But then we've learned that we were more right than we even thought. So QOZ is fully sourced. We're still raising the fund, but we've tied up all the land. We're in pre-development of everything we're doing because sites are the scarce resource, and it'll continue to be that way. So that's the lesson learned there.
Here, Dave, I think we're going on an hour right now, so we should probably wrap it up with one or two more questions. Please comment on any advantage or disadvantage on having your funds in a retirement account. We actually have a lot of retirement account investors. I would say just generally in a retirement account, you want to be in tax inefficient assets, not tax efficient assets. So if you're looking at our funds from tax efficiency across the board, the least tax efficient is going to be the multifamily credit fund. And the most tax efficient is probably going to be your QOZ or Growth Fund 4, but you can't invest in QOZ through a retirement account because you have to invest with realized capital gains to actually get the advantages there. So some people, this is where the bulk of their money is in their retirement account. We do support, we have relationships with all the large custodians out there. So Fidelity, Schwab, Millennium, Pershing. So if you're interested in investing in a retirement account, we can absolutely accommodate you.
I think you're right, Michael. Let's post the results of the survey, and then we can wrap it up.
All right.
Okay, so thank you for lots of participation. It looks like manager experience, track record, asset class selection. And what's interesting here is in the past, amount of capital co-invested surveyed very high. It didn't here. And what's interesting here is, fees were the least important. Fees are important, but I agree with the result. I don't know what you think, but like what you spoke to earlier, Michael, if you select a top SL manager, you might make twice the money or more, or avoid losses. So probably the value is more important than the fees, but obviously no one wants to overpay for fees.
Yeah, it's good results.
Well, thank you for your time, everyone. I did mention that if you wanted any of the portfolio construction analysis that we had presented yesterday to some investment advisors, we're happy to send it. You can reach out to Michael or myself. It's just our names, Michael or David at origininvestments.com. We'll have our team make sure that you get that. Reach out to us. We like the dialogue and we like the feedback. We can always be better. We're striving to be better. So we appreciate that. And thank you for your time. Do you want to add anything, Michael?
No, thank you, everybody.
Okay, bye-bye.